Prescient Holdings is a diversified global financial services and information technology group with about 95 billion rand in assets under management. Prescient Life is wholly owned by Prescient Holdings and was registered in 2006. It offers retail retirement and savings products such as living annuities and endowment policies. Daniel Akers, CEO of Prescient Life, joins us from our Cape Town studios to share the firm's strategy for long-term investing at various life stages. Welcome, Daniel. So we're talking about retirement investing, and I think it's a rather prominent topic in many of our minds, particularly as we approach that point. But clearly it's too late to start thinking about it when you're 50 or 55. And as I think you've pointed out, it is a process.
Absolutely. It is a process, and the earlier you can start, the better. I think the major problem we face in South Africa is that unfortunately people start thinking about it too late in the game, and that would be even the 2 or 3 years up to retirement, by which point it's actually too late to do anything about it.
Daniel, it's Warren here. I just wanted to get straight in and ask you the easy questions first. We've looked at the costs associated in the retirement savings industry quite extensively, and it's obviously a big topic on the lips of no less than the National Treasury, who want to reform the industry to make it more cost effective. I just wanted to understand what your understanding of the different fees adds up to for the investor, the retail investor, when considering their retirement savings, because we're all familiar with inflation and the need to beat inflation, but some people aren't quite sure, exactly what returns their investments need to gain just to sort of stay even. So if you could just give us an idea of the different costs and how you expect those to change going forward.
Sure. And we like to look at costs in kind of 4 different ways. This one is explicit costs, so those are the things that are fairly obvious to the investor. I mean, it's your investment management fees, your broker fees, your platform fees. We also like to look at implicit costs. So these are more hidden costs, things that wouldn't be completely obvious to the investor. That's something like brokerage that would happen on the actual trading within, say, a unit trust investment. There's also things like hidden costs. And this is, for example, if you are paying for an equity product and you're searching for an active equity product, how do those fees compare to a passive index product? Are you actually getting what you're paying for? And then the 4th category would be something like opportunity cost. And this is really the biggest category, and one that hasn't really come into the minds of Treasury or a lot of the other parties involved. And those are the costs of what is inappropriate asset allocation really costing you, inappropriate benchmarks, cost of life stage models and funds. They're all separate topics, and they're all very expensive if you get them wrong.
Daniel, related to that, you've made a point that one needs to have the strength of one's convictions, and that research shows one would get a better outcome by buying and holding as opposed to trying to time the market. Are there also cost implications of that? Buying and holding presumably works out cheaper than trying to time the market, which is one reason why it is a better outcome.
Absolutely. I mean, included in that whole process, all the transactional costs that you're going to incur, specifically brokerage on the underlying securities. You've got bid-offer spreads that apply to all the securities that you're going to be investing in. And obviously every intermediary on the way will take a small portion. So the more frequently you trade on that portfolio, the more costs you're going to incur. And that is a very explicit kind of exercise that asset managers have to do, is to weigh up the benefit that can be attained from changing the portfolio versus the actual costs incurred in doing so.
Daniel, just to ask you a question, you've indicated that asset allocation is a very big driver of returns. I just wanted to understand, where's the best place for a client to make that decision? Is it to make that asset allocation decision with their financial advisor, or do you advocate using the services of a fund manager to make the asset allocation decision for a pool of investors?
I mean, obviously I'm slightly biased in this respect, but I would generally say that going to an investment manager and picking their kind of best view product is certainly likely to get you a good asset allocation feel. I mean, if you believe in the abilities of the manager, then certainly a kind of balanced portfolio that is fairly aggressively invested in growth assets for the majority of your life would serve you well in terms of your retirement investing.
Okay, great. And just one other risk or another cost, I guess, if you could call it that, is we've seen that with the increasing amounts of regulation coming towards the IFAs, that many of them are almost too scared to make certain decisions on behalf of the clients. And something we've seen when we survey fund managers is the fact that some of the niche equity portfolios that have generated solid returns, and the one that comes to mind is the small and mid-cap fund sector, just have no interest from both the retail investor and the institutional investor. And I wanted to see what your impression was of this regulatory hurdle that many IFAs face, and the decisions, the impact on the decisions it's making for their clients.
Sure. I mean, regulation is a cost across the industry. I mean, it's not just in the broker market that it applies, and certainly asset managers are feeling the pinch from having to comply with Regulation 28. It's a huge cost exercise. It's not to say that it doesn't have benefits, but it doesn't come with its costs. On the flip side, life companies are facing the cost of SAM, which is the Solvency Assessment and Management Framework, which is bringing a huge cost. It's a kind of a parallel regime to Solvency II in Europe, and they've predicted that increasing capital costs and increasing regulation will reduce pensioners' annuities by up to 20% just because of those costs.
We apologise for the quality of the feed that we're having from Cape Town owing to bad weather. Daniel, to finish off with equities, would that still be the primary driver of performance? Would that be the choice within one's asset allocation, the emphasis?
Absolutely. I think equities are the only asset class that have shown to give sustainable, substantial, real returns over the last 50-year period. And if we believe in the growth that is to come from specifically emerging markets in South Africa, then sure, it's the only asset class that can give you the potential to beat inflation, beat the cost that you're having to face, and once you get into retirement, also try and keep up with the amount that you're going to be drawing to fund your lifestyle.